Hi, it's Jim Turner, CPA and business valuation expert here, the BizVal guy. Today I want to discuss with you the concept of cash flow with regard to a business. When folks ask me what is the catalyst that determines business value, I respond cash flow. Then I explain that cash flow is synonymous with EBITDA. That's when I usually receive one of two responses. The recipient's response and countenance tells me that they are familiar with EBITDA, or there is a long pause in the proverbial deer in the headlight looks. All joking aside though, unless you work in the finance industry, EBITDA is often a completely foreign concept. So for folks listening to this podcast who are unfamiliar with EBITDA, it is the acronym for earnings before interest, taxes, depreciation, and amortization. To calculate EBITDA, you can begin with net income, let's say of $148,000. Then you add interest expense of $2,000 and depreciation and amortization expense of $50,000. All added together equals $200,000. EBITDA depicts the cash flow of the business without the cost of capital, which is stripped out by removing the cost of debt. Again, in this example, EBITDA was calculated by adding net income of $148,000 plus $2,000 in interest and $50,000 in depreciation and amortization. EBITDA is useful in considering the value of a company because it normalizes the capital structure, tax structure, and net working capital. But there's a limitation to consider. EBITDA does not include capital expenditures necessary to maintain the property, plant, and equipment. In merger and acquisition activity, you will hear the term normalized EBITDA. To get this metric for purposes of evaluation, often owners will need to add back or decrease into EBITDA certain expenses from the profit and loss that are non-recurring or non-operational. The term add backs describes the adjustments necessary to EBITDA to give buyers a more realistic and normalized picture of what level of EBITDA they could actually receive if the business was required. Normalized EBITDA provides the owner with the cash flow stream adjusted to economic reality, which is the benefit stream that they can either sell or enjoy. Personal or non-business expenses are common add-backs. These can include personal travel expenses, personal meals and entertainment, and all other expenses in the P&L that were for the benefit of the owners as opposed to necessary operating expenses incurred by the business. Other common add-backs are excess owner's compensation and non-recurring expenses. For example, if an owner receives $1 million salary when the market to replace the owner's duties is $250,000, then an add back of $750,000 is warranted. However, if the owner's compensation is deficient, then that can result in the need to increase expense, which will decrease normalized EBITDA. An example of a non-recurring expense is a one-time legal fee related to merger and acquisition. Thank you for your time, and look for more videos from me and let me know if there's a topic that you would like me to discuss.